Welcome to the Medfaber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Matt Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Welcome back, everybody. Happy New Year. We got a really great show today. Our guest is Wendy Li, founder and CIO of Ivy Invest, which offers an endowment-style fund with traditional and alternative assets. She spent her career as an institutional investor managing billions of dollars for some of New York's largest endowments and foundations. Today, we're going to talk about her institutional experience and what she's up to with Ivy Invest. Wendy, welcome to the show.
Hi, Matt. Thanks so much for having me. Love your show.
I want to do a little rewind because your backstory is pretty foundational to what you're up to now. Maybe give us a little overview. Where'd you come from? What have you been up to?
Prior to becoming a startup company founder, I spent the bulk of my career as an institutional investor across various endowments and foundations in New York City. I started at the very illustrious investment office of the Metropolitan Museum of Art, where that is an investment program that has been running since the 90s. When I was starting out at the Met Museum after college, it was almost unheard of among my classmates. I went to Columbia, and so Wall Street, consulting, recruiting, it was very heavy on campus. And so the idea of going to something called an endowment foundation was just very foreign. And so everybody just assumed I was going to work at the Met Museum in some sort of art capacity. But having been at the Met Museum Investment Office to start my career, this was back in 2006, had a really formative experience going through the global financial crisis as part of an investment team that was deeply experienced with a portfolio that was very mature. I went then to actually a new investment office at UJ Federation. And then from there, went to an entirely new foundation called the Mother Converting Health Foundation. I like to think I progressively went from more established to less and less established and greater opportunities to sort of build something out. This current endeavor is a completely different build out than, let's say, an endowment foundation build out.
So did they ever let y'all sneak into the gala? Was that happening back then? Were you able to sneak in and be able to rub shoulders with all the stars?
Oh my goodness. So there were two very cool things about being at the Met Museum. The gala, yes, but also the Met Museum would oftentimes serve as the backdrop for movies. And so every once in a while they would be filming and you could sort of peek in on folks and some of the movie stars that came through. Actually, no, there's three things. Obviously, the gala and the occasional film were less frequent occurrences and certainly just a background thing. But the museum was closed to the public on Mondays. And so the real highlight was being able to walk through the museum completely quietly, no crowds, and really just be able to sit with the artwork on Mondays. The entire time that I was there, I want to say they probably changed that policy sometime in the 2010s.
That's awesome. I remember going to the Met when I was country mouse, my early 20s, going to New York and just feeling, wow, what an amazing space. I also remember, as you were joking about, talking about working at the museum with your friends, I remember right out of college talking to one of my friends. I was like, what are you up to? Oh, what are you doing? She's like, oh, I work for Saks. And I was like, oh, Goldman Sachs. She's like, no, it's Saks Fifth Avenue. What are you talking about? And I'm like, sorry, I'm stuck in this finance world of nerds. I have a limited sphere of understanding of the world. All right. So talk to us a little bit about that time. Was Swensen really the guy that came out and popularized this concept of endowment investing? I mean, look, Harvard was doing it 100 years ago, and you had a number of these institutions, whether it's Ford Foundation, on and on, that had this concept of the endowment model. When did it really become part of the jargon, the common space? Was it Swensen with his various books, do you think?
I do. It's funny because I feel like endowment-style investing is such a nebulous term, and folks have adopted it to mean any number of things. But I really do associate endowment-style investing with specifically Yale-style, Swensen-style investing. And part of that is you alluded to Harvard's investment office having also existed for a very long period of time, and they were doing some very interesting things in their portfolio. But Harvard actually had a very different investment model versus what Yale's investment model was. What Harvard had done for many years was that they managed a lot of alternative investments in-house. Some of the ways that that manifested ultimately was there were teams that would spin out of Harvard. They would be some of the really well-known hedge funds in those early days in the 2000s. But Harvard took a very different approach where they managed alternative investments in-house for many, many years. Yale didn't take that approach. And so what I think David Swensen and the Yale model pioneered was really more of a multi-prong approach that I think is more replicable versus, let's say, what Harvard was doing, running and managing in-house teams and in-house strategies, which we can have a much longer debate about ultimately which one is more scalable and which one has translated better to other institutions. But I think the reason that folks associate what David Swensen pioneered with the Yale investment model with an endowment model in general is because there were some key parts to it, which is it is equity oriented. And so the idea is that you have a very long time horizon. On the other end of it, it is about really smart risk taking. I think one of the things that I hear from time to time is endowment style means endowments are looking to minimize risks, or endowments, they're trying to minimize volatility in their portfolio. And I think that is not how endowments think about risk taking. I would say because they're long-term investors, because it's perpetual capital, and because they have a very flexible investment approach, the truth behind this risk framework is much more around finding higher risk-adjusted return investments. And so it's for every increment of risk that you're taking, are you being appropriately compensated? And being able to look across a spectrum of investments, across public markets, across private markets, and finding investments that are generating outsized return for the risk that you're taking. Tying into that, the other thing that's key to the endowment style approach is investing in managers that are experts at what they do and investing in the best people who have the ability to generate outsized alpha in those strategies that they run. So I think there's multiple parts to that where endowment style looks and feels very different versus across institutions. But when I think of endowment style, I think very much of sort of that Yale endowment style, which again, equity oriented, looking for really excellent risk-adjusted returns and looking to invest in managers that are great at what they do, that have strong alignment with their LPs, and then taking all of that into the context of you have perpetual capital, so take advantage of it.
Yeah. There's some ways that we've always said the endowments are not like us. In some ways, they are. This long-term horizon, this massive pool of money gives you a little negotiating at the table. Everyone wants to get that endowment allocation, also as like a gold star of approval. I think Swensen originally published his first book around 2000, at which point the discussion of the Yale model really started to make its way throughout the community. You would have been at the Met, I think, through the financial crisis. Is that right?
That's right. That's right.
What was that time like? Because I feel like every endowment and foundation is different. Some target all sorts of different things, totally different ideas. But what was that experience like for you guys at the time?
Going through the financial crisis at the Met Museum was an incredibly educational experience and something that has stayed with me, not least of which is there were a number of advantages that I think the Met Museum had going into and coming out of the financial crisis. Going into the financial crisis, the portfolio was already a pretty established portfolio with diversification across publics and privates. And so there was a healthy allocation to alternative investments in that portfolio. And so what that meant was that we did not have the same degree of market drawdown in our portfolio as, say, if you had a purely 60-40 portfolio. So that's something that really taught me about the power of diversification going through a massive market correction like what we experienced. One of the things that really stood out to me, this is pre-GFC, I was an analyst, and I was always struck by how every single conversation that we had on a quarterly basis when we discussed the portfolio, there was always attention paid to the liquidity profile of the portfolio. We spent what I, at the time, thought was an outsized amount of attention talking about how much daily liquidity we had, how much monthly liquidity we had, how much quarterly liquidity we had, what the lockups were across our alternative hedge fund portfolio, what the expected commitment pacing was. We very early on used the Takahashi-Alexander liquidity horizon modeling for illiquid investments. We always were very conscious of What are we expecting capital call pacing to look like? What do we expect distribution pacing to look like? What do we expect the NAV in our private portfolio to look like? So this was back in the day when all of this was done by Excel. I hand entered a lot of this information. This is before these models became part and parcel of any sort of tech software program you might have for portfolio monitoring today. But in terms of that piece of the portfolio, in terms of thinking about liquidity so closely, in terms of having that mindset, it was something that served us incredibly well.
One of the big challenges that the headlines really captured in 2008, 2009, so the endowments do a lot of things great. The endowments have this super long time horizon, but the problem is in the interim, if markets go down 50% and you have all these private markets and they're not liquid, they can run into cash funding constraints. And that's the same was true with all of us. If we have a ton of leverage on our personal balance sheet or we have these commitments, it's not like you can liquidate a lot of them instantly. And if you want to, often it's like at a huge discount. So how do you think about that during these periods of massive stress, both having lived through it, but also now with the fullness of time and thinking about it going forward? How do you balance that sort of illiquidity on certain types of investments, even if you have a very long time horizon with these shorter term, hey, I have to make it through this period to really realize these alternative type of returns and premiums?
I think there's a couple pieces of that, which is there has to be just a perpetual consideration of liquidity in the portfolio. It can't be you go through this period of liquidity crunch and then all of a sudden you're thinking, how do I raise liquidity in our portfolio? I think there has to be this constant awareness of what are the needs and what does a stressed portfolio look like and where would I pull liquidity if these scenarios occurred? And that's one of the things that the Met had always had a good sense of. If we needed liquidity, where would it come from? We always had more liquidity than we needed. When we were going through the global financial crisis, we were never concerned about an inability to meet capital calls or an inability to fund the less liquid parts of the portfolio, which on the flip side of that, when we were coming out of the global financial crisis, meant that when those long equity managers were putting in calls to us and saying, this is a great time to add to your investments, this is a great time to add to your portfolio, we were able to do that and we were able to invest with strength coming out of the global financial crisis in 2009 timeframe. The other thing that was really interesting about that timeframe was it really highlighted to me, going back to this, not all endowments are structured the same way. Our office was very cognizant of what it would look like if we had, nowadays we call this the denominator effect, where, to your point, public markets drop a lot and your private market investments are not being marked the same way. All of a sudden, your private markets look like an outsized part of your portfolio. That, I think, is more of a mark-to-market issue. The bigger issue is if you are receiving capital calls and you don't have liquidity in your portfolio to fund them, which was a thing that happened at certain other endowments and foundations where they were overextended in terms of their private allocations and they would not have been able to meet capital calls for investments in that time period. That was actually one thing that I saw where there was almost like a bit of tension where there were LPs like us, the Met Museum, who had liquidity, who would have liked to have seen our managers call that capital and take advantage of opportunities in that market. And then knowing that there were also other larger LPs who were telling those managers at the time, don't call capital. There was distinct tension there. When you have liquidity, if you're always thoughtful, it just gives you greater flexibility to capitalize on investments when there are real opportunities in the market.
Let's talk a little bit about alternatives. Back when Harvard was doing this 100 years ago or whatever, alternatives might have meant timber. And even if you talk to the average investor, probably 50 years ago, alternatives might have meant foreign stocks. They might have meant REITs. Commodities were one that a lot of people have very polarizing views of. But fast forward to 2025, and most of these investments have sort of been going down this curve of alternatives to maybe almost just like, hey, I can buy that in an ETF pretty easy. Some you still can't. Timberland example. Maybe highlight a few of what you consider to be the big alternatives. And you can choose to interlace this question with your experience at the Met and other periods where you're like, I have a very memorable time researching timber in the Northwest, or we had a manager come in and he was pitching us collectibles and baseball cards and art, whatever it may be.
alternatives cast such a wide net. And the interesting thing about alternatives, the drivers of returns across these markets are so varied. We can set aside what are almost traditional alternatives now, which are sort of your private equity investments, venture capital investments. And there's all sorts of varied types of investments that have come up, which I typically bucket under, if I had to, I'd call them private credit type investments, where you've got things like music royalties or litigation finance, or to your point, one of the more interesting things that has come up recently, which I should say, not something I've invested in, but everything to a manager that once was telling me about a whiskey barrel investment sleeve of their portfolio, just non-correlated assets.
Did they make some liquid jokes when they were talking about it? Because I feel like you kind of have to if you're talking about wine and whiskey. Every time I've heard about it, there's at least one liquidity joke in there.
Exactly. The funny thing about this, and I think LPs will appreciate and institutional investors will appreciate, is that something that would strike an individual investor as being really far out on the spectrum, if it is something that can be turned into an alternative asset class or an alternative asset investment, the number of managers that will pick up on that strategy, and if it is something that has a distinct enough return stream and it has a distinct enough strategy behind it that you can repeatably execute it, before you know it, there's going to be multiple players in even these more obscure investment strategies. This is why I go back to institutional investing, and investing into alternatives is as much about understanding the different investment strategies as it is looking for the managers who can maintain an investment advantage in those strategies. But to your point, I think alternatives is such a broad category, and I would bucket it into equity-oriented alternatives, which are more private equity, growth equity, venture capital, and then sort of non-equity alternatives where you have more private credit-oriented investments, which broadly fall under either direct lending or asset-based lending. And asset-based lending is one of these really broad categories of alternatives, which would include everything from aircraft leasing to these whiskey barrels. And then there's sort of this other category of alternatives, which are much more, I would call them almost hard asset alternatives and real asset alternatives. And that's where you get to oil and gas and energy and the exploration and production managers and strategies. And you get to alternatives like, I almost hesitate to say this, but you start to get to alternatives that are more gold or crypto or things like that. And you start to get to things that I'm not entirely sure I would call them institutionally investable alternatives. But if we were just talking about institutionally investable alternatives, I would bucket it under equity-oriented and then non-equity oriented and then really hard asset type alternatives.
Before we dig into kind of what y'all are doing now and some more of these specifics on these, do you have any particularly memorable moments from the time at Met? It could be manager conversations, it could be allocations, due diligence requests, anything particular that stands out as fun stories from your experience at the helm of one of these big foundations and endowments?
You get pitched a lot of things when you are sitting in one of these seats. And I would say, I think that's something that maybe is harder to appreciate when it's not your day to day. I would say easily we would meet anywhere between across the team over 500 managers a year.
Wow.
Easily. Individually, I probably would meet with close to 200 to 300 managers a year. You're seeing a lot of different strategies, and there's a lot of really bad strategies out there.
You can name names. I'm just kidding.
Which is not to say. There's strategies that don't fit what endowments and foundations, or at least the endowments and foundations that I worked at, didn't fit what we're doing, which is one set of strategies. There were other strategies that just didn't necessarily make sense. And I always found it interesting when I would meet some of these strategies because I was always sort of curious if the manager themselves had ever sat back and thought, like, who would want this and why? There's one manager in particular that really sticks out to me to this day because we had a very pleasant conversation to start and getting to know each other, and really pleasant individual. And then as we got deeper into the context of this strategy, he had this similar misconception of what an endowment foundation might be looking for. And he was very convinced that because endowments and foundations have the spend policy, that was our return hurdle. And as long as it could meet that return hurdle, or what he perceived to be our return hurdle, that spend rate. He was very convinced that if his strategy could offer a guaranteed return that met the spend rate, that should be incredibly compelling because it was a guaranteed return.
You say, hey, that's called T-bills. Isn't
Well,
that about the spin rate, right? At the time, it might have been zero. Today,
at the time,
today
T-bills were zero,
T-bill.
right? So at the time, T-bills were zero, and he was like, here's a guaranteed 5% return. I guarantee you this return, and all you have to do is lock up your capital for 7 years. The whole concept behind the strategy was that he had identified that community banks were issuing this pocket of capital that was too small in size for any sort of institutional investor to look at. Too small for BDCs, it was too small for SBICs. He had identified that there were these non-investment grade bonds that were being issued by these community banks, and he'd identified them as being super safe and identified that these were primarily being purchased by other community banks. He identified these bonds as something that he could purchase, that he could then tranche out as super safe, 5% guaranteed return, and then another tranche that would have much more variable return and a higher return potential. But the challenge is that there's not much of a secondary market for these. And so they're sort of held to maturity type investments, which he was very insistent that these were going to be money good and that there was very little risk of impairment. And I didn't necessarily disagree because community bank failure, while it happens, is not something that was as much of an outsized concern in terms of understanding the strategy. The funnier part to me was when he kept insisting that if you lock up your capital for 7 years and I can guarantee you a 5% return, and insisting that this was the type of investment that should meet the needs for an endowment or foundation, and everyone with the spending need should be putting a portion of their capital into this. It was just wild to me because he didn't appreciate that for endowments and foundations, when we think about locking up capital, the return hurdle for capital that we would lock up is well in excess of mid-teens. The idea that he was offering 5% was just sort of wild to me. And it was more his insistence that he understood what our risk profile was better than I did.
It's interesting we have an old tweet about asking people what rate would they accept to call it a day. What would be the return? And I'm not going to spoil the answer because I actually don't know what it is, but we'll put it in the show notes, listeners. It's an interesting takeaway. As we move forward to the present, I want to talk a little bit about this naive optimism to now be an entrepreneur. We joke with all of our friends that have started down this very hellacious path of starting a new biz. First of all, congratulations. Let's talk about what you're up to. You leave these comfy confines of the big money institutions. You did a stint at Mother Cabrini as well. And then you said, you know what? I'm ready to start my own, hang up my own shingle. Talk to us about Ivy Invest and what you're up to.
When my co-founders and I thought about building out Ivy Invest, the idea behind what we're building is really endowments and foundations have been investing in a portfolio of publics and privates. The endowment-style portfolio has over time delivered better risk-adjusted returns, better absolute returns versus a stock bond portfolio. Why is that not available to individual investors? And there's actually a whole host of reasons why it's not available to individual investors. But we really thought about it in terms of, well, what are the various barriers? And if we had to name them, what would they be? And is this solvable? Then how can we bring that to the market? Again, this sort of goes back to some of what I had learned in my years at the endowment foundations, was that the less liquid parts of the portfolio, those alternative parts of the portfolio, those private market investments were often the biggest driver of outsized returns over time.
So we started Ivy Invest to give anyone access to a professionally managed fund that includes alternative investments in private markets. And the great part about our fund is you don't have to be an accredited investor, and you only need to meet the $1,000 investment minimum.
How do you do it? Let's hear it. What's the punchline?
So it turns out that there were 3 primary barriers to why this was not currently available to individual investors. The first barrier was really structural. What is a vehicle in which we could take a diversified investment approach, have a flexible investment approach to invest across publics and privates, and that vehicle can also take in individual retail capital? So just from a structural standpoint, there's not a lot of choices. Our fund is structured as an interval fund. It is a closed-end fund. this has become a structure that is, I think, increasingly adopted by asset managers. It has the benefit of being both flexible in terms of what types of investments we can make in the vehicle, and it also has the benefit of being a 40 Act fund, so you can take in individual retail capital. The second barrier is typically investment access and investment expertise and investment knowledge. That barrier was easy for us to solve, just given my own background and my network, my past experience. And then the third barrier was really, how do you deliver this to individual investors? Well, one of the challenges for even the other types of alternative investment structures that are being made available to individual investors today is that these investment interval funds outside of ours typically have to be purchased through financial advisors. And so there is an entire segment of the market where if you don't have a financial advisor, you don't have access to alternatives at all. My two co-founders have a tech background. We were able to build for ourselves a proprietary technology platform that allows us to directly deliver our fund and, by extension, a portfolio of publics and privates and investors to consumers directly.
Yeah, and I've seen it, listeners. It's pretty slick. Tell us about it. How do they access it? What's the way they interact with this? Is it a fund? Is it an app? Is it a website? How do they do it?
Our website is ivyinvest.co, ivyinvest.co. Any individual investor can log on to our website, can create an account, and can access our technology platform, and then can purchase shares of our fund. We keep it super simple. One share of our fund gives you a portfolio of publics and privates. We also have an iOS app. It's very easy to open an account and invest either taxable dollars or where we think individual investors are best served and the type of asset that we think is the best fit asset for our investment approach. It's really retirement funds. And so we also support individual retirement accounts, support 401k rollovers and IRA transfers. And so really trying to find a way to make this easily accessible where it's one fund. It's applying my investment expertise and knowledge to put together this blend of publics and privates for our investors.
Perfect. All right. So I go to your app, your website. I say, all right, listen to this great interview on the Meb Faber show. I want to give you 100 grand, $1 million, $10 million, whatever it is. What am I getting? What's this portfolio going to look like? Give me a peek behind the curtain.
So one of the things that we felt very strongly about early on was that we wanted to make sure for investors that there was a clear day one value proposition in terms of how our fund delivers value to our end users. And what that meant to us was that we wanted to be able to deliver to our investors a portfolio of both publics and privates at our strategic target asset allocation from the get-go. And so our portfolio today is about 55% public equities and fixed income and 45% alternative investments.
Holy mackerel, I like it. We're going to call that the Wendy portfolio. So roughly 50-50 public equities and fixed income, 50 alts. What's that broad alts umbrella? I feel like most people are like, all right, I can get what you're talking about with the public stuff, but let me hear the good stuff. What are you guys throwing in there? Do you have like a target rough allocation in your mind?
The allocation today is pretty much in line with what I would expect it to look like long term. We have 20% in private equity. We have 10% in private credit, which is a split between direct lending and asset-based lending. We have 5% in special situations, opportunistic credit. We have another 5% in real estate, and we've got a little bit less than 5% in infrastructure. And so our portfolio is this blend of what I would consider of that alternatives. There's equity-oriented alternatives, there's non-equity-oriented alternatives, and there's some real asset alternatives in there as well.
And so how do you source these? It's obviously a continuous process. And I imagine a lot of these relationships you've had over the years, but how many different managers is this? Is this like half a dozen? Is it like 50? How do you think about getting them on board?
Right now, it's a half a dozen managers. Our managers are managers I've known for a long time. These are managers that are household names from an institutional investor standpoint. And so when I think about some of these I've had longstanding relationships with and have invested with and in my prior institutions, one of the key distinctions I would make in what I'm doing now versus how it invested on behalf of endowments and foundations is that I'll use the Mother Cabrini Health Foundation as an example. When I stepped into the Mother Cabrini Health Foundation, It was 2019. It was a brand new foundation. I was stepping into $3 billion in treasury bills, which is phenomenal for an institutional investor. It's like an institutional investor dream.
It's like Christmas morning. What am I going to do with this?
Yes,
Right?
exactly. Who gets $3 billion in treasury bills to say, then deploy this capital across the portfolio, across different asset classes, along the investment principles that you've learned, and really prove out your beliefs in terms of building out an institutional investment portfolio. And so you step into $3 billion in treasury bills, and you have a perpetual investment time horizon. Again, building blocks 101, thinking through what is the long-term strategic asset allocation that makes sense for this institution. How much of this portfolio do we intend to allocate to private investments? And then because you have a perpetual time frame, it is reasonable to say, going back to sort of first principles of how do you build a privates portfolio? Well, you make sure that you have good vintage year diversification, you have manager diversification. And so you're really thoughtful about commitment pacing and building this portfolio out over time. We horizon modeled day one that we were going to build to a 25% allocation to private equity, for instance, over a 7-year time horizon. The way that that gets built out is very different than what I'm doing here at Ivy Invest, where I don't really have the luxury of saying to prospective investors, I promise you in 7 years' time, we're going to have the types of alternative investments that you are seeking today. In the context of Mother Cabrini's portfolio, as we were building out, we were very strategic in using secondary private equity investments along with primary private equity investments. At Mother Cabrini, we were making investments in traditional 10-year life drawdown commitment fund vehicles. Here at Ivy Invest, the reason that we're able to invest into privates and the reason that we're able to build the kind of portfolio that we're building today is because there is a dramatic shift that's happening on the alternative asset side of the world. When I say that I couldn't have done this 5 years ago, there's multiple layers to that, not least of which is it's so important if you are interested in investing in private markets and alternative investments, investing with managers who know what they're doing, who have deep expertise. And expertise and decision-making looks different across different investment strategies. So for instance, if we're talking about asset-based lending, or we're talking about aircraft finance, or if we're talking about specialty finance, with those types of strategies, you would distinguish the things that set managers apart are their sourcing and their flow. With different types of strategies, the qualities you're looking for in a manager look different. One of the things that's shifting on the asset manager side of the business is that alternative asset managers are interested in bringing in individual investor capital. And so what I mean by that is previously, 5 years ago, when we were building out Mother Cabrini's investment portfolio, there's effectively one way to invest into private equity, and that was through these traditional 10-year drawdown vehicles. Today, there are a number of private equity managers who have put their strategies into evergreen structures. And these evergreen structures have a number of advantages for individual investors, not least of which is there's no J-curve. There's, depending on the manager you're investing in, there's manager diversification, there's vintage year diversification, and it meets a lot of the best practices of building out a private equity portfolio that we at Cabrini would build through individual commitments to individual managers over time. Today, because of these evergreen investment structures, there's an opportunity for individual retail investors to have an immediate NAV in the ground type of investment that is, depending on the investment, has both manager diversification and vintage year diversification.
How should these investors say, okay, I like what I hear, I want to give you some money. What's the liquidity profile? I assume this isn't as easily tradable as an ETF. Do they got to hold it for 10 years? How do they get out if they do want to get out at some point?
The interval fund structure, it's pretty standardized. It is a daily purchase. It's quarterly liquidity, but we offer to repurchase shares on a quarterly basis, and we offer to repurchase up to 5% of all outstanding shares. Our investment approach and our structure is really meant for long-term investors. Why we go back to sort of the retirement assets are a great natural fit for what we do because those are long-term horizon investments. But it is still, at the end of the day, we offer quarterly liquidity. This is what I would consider semi-liquid. The asset management side, alternative asset managers And their decision to create these evergreen structures for individual investors was very much around this recognition that individual investors really struggle with commitment vehicles, long lockups, and managing capital calls and distributions. That's just not an exercise that's familiar to many individual investors. Institutions are used to that, and we can manage our liquidity. And that's why I think it's important to think about your investments in privates as part of an overall portfolio allocation construct. But individuals don't have that practice and don't have that mindset. And so I think there was a broad recognition, or I say there is now a broad recognition that in order to attract or in order to bring something to individual retail investors that is going to stick, it has to be in the form of something that is evergreen, that has some sort of more frequent redemption possibility than 10 years. I purchase this, I can on a quarterly basis redeem. Those are more natural actions, I think, that individual investors are familiar with. And the other piece of it is also, I'm sure you know this, Meb, K1s are not a terrific thing as an individual investor to receive if you're not used to filing K1s. And so a lot of these evergreen structures also seek to issue 1099 divs. And so they're just, again, from an individual investor standpoint, it just makes your life a little bit easier.
Yeah, I can identify with that very, very closely. Why should investors think about this? I feel like we're at the point in the cycle. There's some other structures that the retail crowd is looking at. Some of them are kind of harebrained and poorly designed. What would you say to some of those people that are considering this type of idea, this type of concept? Any general thoughts, suggestions, warnings?
I think what you're referring to, Meb, is something that I find totally understandable. I think individual investors are very well aware that they have not had access to the broad investment universe. I think individual investors, clearly there's an appetite among individual investors to access more than just stocks and bonds. And I think because the outlets available to individual investors have been so narrow, you end up seeing interest spike in things that are outlandish and unproven. But it's like what we saw with, I don't know if you remember, sort of this craze around DXYZ, which was this listed closed-end fund that promised access to private investments. There was a lot of frenzy around that, and you see it pop up. Cryptocurrencies, I think, attract a lot of attention and attract a lot of capital. And I'm not going to make any comments around any particular cryptocurrency, but just going back to things that are viewed as alternatives to stocks and bonds, and when they become available, you see it pop up with individual investors and passing fads. And one of the current fads is what I think are the rise of these copy trading platforms where individual investors can copy trades from whether it's famous investors or politicians or just other random people on the platform. I think all of these trends or these fads speak to an appetite for something beyond just steady stock and bond portfolios. And what I would offer to investors instead is that the reason that those have had to serve as outlets for individual investors is because the more proven paths were just not available to individual investors. The more proven path of proven alternative asset classes, proven alternative asset managers have not been available to individual investors. And now that that is changing, and we're very actively changing that through Ivy Invest, I would posit that rather than going to these unproven types of investments, you can expand your investment horizon, expand beyond stocks and bonds with proven investment strategies, proven investment asset classes, proven investment managers. That is, I believe, far more compelling and has a much greater likelihood of success.
As we kind of look out to the horizon, you roll out this product, get investors, and maybe the S&P just keeps going up 15% a year for forever, but maybe it doesn't. The endowment, I feel like that 2000 to 2007 period was really a magical time, not just for the endowment style, really for anything that didn't own cap-weighted U.S. stocks. And I feel like there's some rhymes and similarities to kind of that late 90s period to where we are today. Some of the investor behavior certainly definitely has some rhymes, all the huge interest and uptake in gambling. But as you look out to the future, how do you think about managing this portfolio, diligencing new managers, adding new assets, asset classes? What is the vision you have?
I like where our portfolio is today because the goal at the outset is to have a portfolio that has the asset allocation, has the exposure to the strong managers in the asset classes I know are going to deliver outperformance on the alternative investment side. That was step one, is build a core portfolio that gives me exposure to the managers and the asset classes that I want. It provides our investors with a strong publics and privates portfolio. The next phase of our portfolio build-out is really to incorporate managers and investment strategies that are a little bit less outside of the core. And so it will be investments in things like biotechnology or venture capital. I'll likely layer in a little bit more on the specialty finance, asset-based finance side. There are certain strategies that I'm not currently pursuing. I have no hedge fund exposure in my portfolio. That's likely to always be a very small part of what we do.
Why is that?
Hedge fund strategies broadly are challenging for taxable investors. Many hedge fund strategies on an after-tax basis are less compelling. That's not to say all. I think hedge funds is another one of those asset classes where it's so broad it doesn't actually mean anything. And we always joke on the institutional investor side, I think there's sort of a very commonly used refrain, common joke, that hedge funds are a fee structure, not an asset class.
Yeah.
Setting aside the fact that hedge funds is a very broad term to cover a whole host of investment strategies. Originally, hedge funds were meant to be long, short equity strategies, actually hedging the portfolio with shorts in addition to longs. It's expanded to lots of different credit-oriented strategies, multi-strat, event-driven strategies, multi-manager platforms. There's so many different strategies that fall under that bucket. But there are certain strategies that are interesting to me. It goes back to finding structural opportunities and a manager that can execute on that opportunity well. Within hedge funds, there are certain sleeves that continue to be interesting in our structural opportunities. There's certain managers I know can do that well. And so I would say, while hedge funds will not be a large part of what we do here at Ivy Invest, I think there are certain strategies that we would consider. And longer term, as we look out in terms of what's possible in our portfolio, we would expect to also evaluate different types of asset classes that are evolving. One area that I think is really interesting that I'm spending some time on is what's happening right now with sports and media and entertainment strategies. I think this is an asset class that is evolving and evolving quickly. And I think there are some managers that are doing really interesting work in approaching it in different ways.
Talk to me about skin in the game. I know that's a topic that we preach probably too much on this podcast, but I think it's important. Others less so. How do you think about investing not only in your own offering and strategies, but also managers who are putting money to work for you and your clients?
I know one of the charts I've seen you show is around mutual funds and how little some of the managers have in their own funds. And we built this in part for our own capital. I have a large part of my liquid net worth in this fund. My co-founders do as well. I mean, we seeded this fund with millions of our own assets. And so
I love it.
This is how I want to be invested. And if anyone would ask me how they should invest, I don't need to tell you. Like, you can see it in my portfolio.
Yeah, that's what we tell people when we launch funds. I say, look, we launch ideas that we want to put our own money into. And if anyone tags along, great. But you'll take comfort in knowing that this is designed for our own interests. And as opposed to our friends that just chuck everything against the wall and see what sticks, it's like a product in search of fees in a product in search of an audience, as opposed to, hey, build something actually, at least an audience of one. And usually that means there's an audience of a lot more behind it.
When I talk about manager evaluation and due diligence processes, I think the way that institutions underwrite investments looks and feels very different to what might be more familiar to individual investors. And what I mean by that is institutional investors, when we look to invest in a manager, we're underwriting the people, we're underwriting their process, and we're underwriting alignment. And that is something that is very different from, say, an individual investor that may be looking to invest in, do stock picking or anything like that, because the process of investing in a manager and underwriting a manager and due diligence just looks and feels very different versus investing into a stock per se. And to your point, Mab, about alignment and how much skin in the game does somebody have, that's a core piece of understanding how aligned are you with the manager in any investment strategy. We would always ask the question, how much of the capital under management is internal capital?
What's the magic number? As much as possible?
Funny enough, it's not as much as possible. I think there's a balance between a manager being really committed to seeing an investment through and having it be an important part of their future wealth creation. This is sort of the life cycle of an investment manager. An investment manager that is maybe toward the back end of their career, where they have the vast majority of their wealth in their fund, you begin to see shifts in their risk appetite that may not align with what you're looking for in that manager. I'll use an example. This was a small cap, long short equity manager that we had backed and had a terrific track record, really fantastic track record for many, many years. And then one of the things that started to shift, that we saw shifting over time, was just as the manager had an enormous amount of their capital invested in this fund and this strategy, their risk appetite had started to change. The net gross ratios were starting to change. The types of investments they were making was starting to change. Position sizing was starting to change. And I know you were asking this facetiously. Is it as much as possible? It is, but it isn't, because it goes back to how does it incentivize their behavior?
Collect fees and chill. If you look at like a lot of very classic macro hedge fund managers from back in the day, vol wasn't even consideration. They're just printing these 30, 50%, 100% years. And then over time, you see just go, where they're like, all right, if we do 10, 12% and 10% vol, like, I'll take it. I think that's a very interesting comment on what are you getting when you buy this? Are you getting the swashbuckler, or are you getting kind of the diluted content in there, clipping 2% fees sort of manager? The discretionary manager valuation, I'm glad it's your job and not mine, because it's tough. Some of these groups can kind of evolve and change over time, regardless of the skin in the game. That's a great point.
We say a lot of times that it's a running joke. You see it in all sorts of disclosures that past performance is no guarantee of future results. And it's so true, because you're constantly, for us as institutional investors, for me as an investor and other investment managers, it's a constant underwrite. It's an ongoing and regular evaluation process, because I can't purchase past returns. I have to believe that the investment manager and I are aligned on a continuing go-forward basis.
So you get to go sit down. You get all your buds from Cabrini and the Met and former Yale, all these people in your world. What's something that you would say at lunch where most of your professional peers would shake their head and disagree about? They're like, man, that Wendy, she doesn't know what she's talking about.
You mean other than leaving my endowment foundation seat to start a company from scratch?
That's a good one. I mean, look, that's a good one. It's your pick. You can pick and choose.
One of the things that I have a real fundamental difference of opinion on is my belief that the evergreen fund structure that we're starting to see, and we're increasingly seeing coming out of alternative asset managers, is a good thing for the market. I think there is broader agreement that in private credit, and certainly in direct lending, for instance, that investment strategy fits well into a evergreen semi-liquid structure. I think that there is a lot less agreement on other investment strategies and how they do or do not fit into a semi-liquid evergreen structure. And I think a lot of it is, there is the argument that it is a potential asset liability mismatch, that there is the question of whether or not the investments that are being put into the evergreen structure are as compelling, or whether there's the cost of capital being applied and the return expectations that are going into the evergreen structure are aligned with what the manager is doing elsewhere. I step back and I say, okay, well, high level, if we are in agreement, and everyone would tell you that they're in agreement that individual investors have for too long been locked out of parts of the market that have delivered better returns, they should, on a go-forward basis, have access to these markets with the managers who know what they're doing. Then we have to acknowledge that the current structures that work for institutional investors don't work for individual investors. There is not a world in which individual investors, if you truly believe that access is important, individual investors are going to be able to meet the complexity of these 10-year commitment, locked up, drawdown vehicles. These evergreen structures, these semi-liquid vehicles, when invested well, when managed by managers who know what they're doing, there is a path to asset classes that were not previously possible. given the existing structures.
I mean, look at SpaceX alone, 350 billion valuation. I mean, that's a company that, and many of these, I mean, unless we see just a massive unlocking of the IPO pipeline, so much value has been captured in the private markets that would have been captured in the public markets in prior decades. So it'll be interesting to see how that plays out.
Just to like piggyback on that point, I think it's really, really jarring when you actually look at the numbers. So to your point, SpaceX is an anomaly, $350 billion valuation. It's to this point, the company is entirely privately funded. If you just think about what SpaceX would be at that market cap, if it were a publicly traded company, it would be like top 30 in the S&P 500. That's an enormous amount of value that's been generated for the private investors in that business. And it's not alone. There's others that are like it. And some of the statistics that I've seen, there's just the median age of a company at its IPO, putting SpaceX aside. 1980, it was, I think, 6 years. 2022, that's 12 years. And so companies are just staying private longer, which means that more value is accruing to private market investors who are able to access those investments while the companies are still private. This one, I think, gets thrown out quite a bit and came out in, I think, the Bain Private Equity Report. More than 19,000 private businesses in the US with annual revenues greater than $100 million. That's, I think, fewer than 3,000 public companies of that size. Again, private markets are just much bigger than I think folks realize. And then the one that I think is more recent, maybe this reverses, but maybe it doesn't. Take privates. Take privates since 2022. Something like 3.5 times more companies have been taken private than have gone public since that time. And so it's like there are all these really interesting indicators of private markets. We can sort of delve into why this is, but private markets are expanding. And I think for a lot of companies, the ability to stay private for longer because their capital exists and there's willingness to fund these companies while they're private, and there's willingness to continue to provide capital to these companies while they're private. And I don't know who wants to be a public company.
Nightmare, not me. Absolute nightmare. I don't know why anyone would want to do it. I guess at scale, I get it. Some of the benefits, the liquidity, but man, headache. So as you look back on your career, you're still young, long way to go, but what's been the most memorable investment? And you in particular, it can either be personal, but also it could be most memorable allocation situation. So it could be someone you allocated to that went great, went bad, in between. Anything come to mind?
I'll give a personal one that I think speaks to, because I'm an institutional investor, I think I have a very different perspective on what I did personally. My personal one is in my 20s. This was like toward the end of college. As I was graduating, I started making single stock investments into my personal portfolio. I think this is where everybody starts. Everybody starts with single stock investments. I decided that it was clear that Apple was producing iPods that everybody was purchasing. And so I was like, I'm a genius. I think this is the right company to buy. I purchased shares of Apple at the time, and it went up maybe like $5 or $10. And I was like, okay, this is great. I'm going to take my money out. And then I invested it in some other things. But I would go back from time to time and be like, oh, I should have just stayed invested in Apple. And so I was like, okay, I'll just put my money back into Apple. And so would purchase more shares of Apple, go up another $5 or $10, and I would sell it again. And I did this a few times until 2007, at which point it became clear to me because I was at the Met Museum and I was beginning to understand the power of being a long-term investor, of when you find a good compounding company and staying invested. And so I pretty much after that point mostly stopped individual stock investing, but I just kept my dollars in Apple. And I think I'm at like a $3 cost basis right now. And so I actually think about how my single stock portfolio is very, very skewed.
Wendy, this has been so much fun. Remind us again, where's the best place for people to go to find more information on your new offering and what you're up to, what you're thinking? If they got to ask a CIO something, where do they go?
If anyone is interested in learning more about what we're doing, our company is at ivyinvest.co. And I do run a newsletter. I try to run it advice column style. And so if anyone has a question around how an institutional investor might think about something, you can find my newsletter as askacio.ivyinvest.co. And this has been such a pleasure, Meb. Thank you so much for having me on. This was a ton of fun.
Thanks for joining us today.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.